Would you ever sign a mortgage so long that your kids or even grandkids might still be paying it off? That's the conversation now happening after former President Donald Trump floated the idea of a 50-year mortgage. The concept is simple. Stretch payments over a longer time to make homeownership more affordable. But when you break down the numbers, it's not as straightforward as it sounds. In today's market, where the average 30-year mortgage rate hovers around 6%, some see the idea as a quick fix to lower monthly payments, while others warn it's a financial trap that could leave homeowners paying double or even triple the value of their property over their lifetime. For example, imagine a young couple buying their first home in 2025 for $500,000. Under a standard 30-year loan, they'd finish paying by 2055, likely in their mid-50s or early 60s. Under a 50-year loan, that same couple wouldn't own their home free and clear until 2075, if they're still alive to see it. While the idea of lower payments might sound appealing during tough economic times, the reality is that most people move, refinance, or sell long before the loan ends, meaning they spend decades paying mostly interest with very little equity growth. The question is whether a 50-year mortgage truly helps buyers or just makes them feel like they can afford more than they actually can. Over the next few minutes, we'll look at how this proposal compares to traditional loans, what it means for buyers, banks, and the housing market, and why this solution might do more harm than good. The 30-year mortgage wasn't always the norm. It came to life after World War II when returning soldiers needed a way to buy homes. The U.S. government stepped in to support home financing, allowing banks to stretch out payments over 20 or 30 years instead of demanding full repayment within 5 or 10. This created stability and boosted homeownership rates dramatically. It gave ordinary working Americans, teachers, factory workers, and veterans the chance to buy homes without facing impossible payment schedules. By the 1950s, the 30-year fixed mortgage had become the gold standard. People loved the predictability of knowing their monthly payments wouldn't change for decades. Even as the housing market evolved with new products like adjustable rate or 15-year loans, the 30-year fixed became the cornerstone of American housing finance. Today, over 90% of borrowers still choose it because it offers a balance between affordability and predictability. If we imagine the 30-year mortgage as the reliable sedan of the lending world, steady, familiar, and safe, the proposed 50-year mortgage would be like a concept car no one has test-driven yet. It promises a smoother ride but hasn't been tested on the real road. That uncertainty makes experts nervous, especially when the 30-year system already works for most households. Trump's idea of a 50-year mortgage appeared in a social media post comparing himself to President Roosevelt, who originally helped establish the 30-year mortgage standard. The pitch is that by stretching out payments, buyers can lower their monthly costs and qualify for homes they otherwise couldn't afford. Large developers quickly expressed interest, seeing it as a way to attract more buyers and keep construction booming. But critics argue that it's a cosmetic fix to a much deeper problem: home prices that have far outpaced wages. Imagine a buyer who can only afford a $400,000 home on a 30-year loan. A 50-year loan might let them afford a $450,000 or $470,000 home, but the total interest paid over those decades would erase any real savings. Essentially, it makes the house look cheaper on paper while making it far more expensive over time. Real-world parallels already exist. Japan introduced 100-year mortgages in the 1980s, allowing debt to pass from parents to children. When housing prices crashed in the 1990s, many families found themselves stuck with homes worth less than the remaining debt. That historical example raises a fair question. Would a 50-year mortgage in America help first-time buyers or just trap them in a longer financial commitment with little payoff? To understand why longer mortgages don't automatically mean cheaper housing, let's look at how they actually work. Suppose you buy a $500,000 home with 20% down and take out a $400,000 mortgage. At 6% interest over 30 years, your monthly payment would be about $2,400. Now, if you cut the term to 15 years, that same loan jumps to roughly $3,300 per month. The 30-year feels easier to manage, which is why most buyers choose it. It's simply more affordable month to month. However, here's the catch. Early in a mortgage, most of what you pay goes toward interest, not the principal balance. On a 30-year loan, it takes over a decade before you've paid down even a quarter of your loan amount. That means for the first 10 years, you're mainly paying the bank for borrowing the money, not actually owning more of your home. On a 50-year mortgage, that delay becomes extreme. It could take 20 years or more before a meaningful portion of payments go toward building equity. Think about a real family, say a 35-year-old couple planning for retirement. If they take a 50-year loan, they won't finish paying it off until they're 85. Even if they plan to sell earlier, they'll likely owe most of the original balance for decades. That's not a path to financial freedom. It's lifelong debt disguised as a smaller monthly bill. Here's where the numbers expose the illusion. On a $500,000 loan at 6% interest for 30 years, the payment is about $3,000. If we stretch that same loan to 50 years while keeping the rate the same, a highly unlikely scenario, the monthly payment only drops to around $2,630. That's roughly a 10% savings, not the dramatic reduction most people expect. But the real problem is that lenders won't charge the same rate for such a long loan. They'll likely raise it to 7% or more to account for added risk. That bump nearly erases any savings. Under those terms, your payment might actually increase slightly instead of falling. In total, you'd pay over $900,000 in interest, nearly double what you'd pay on a 30-year mortgage. For instance, a family in Phoenix might look at a 50-year mortgage to afford a new $600,000 home. The difference in payment could be just a few $100s per month, but over the life of the loan, they'd pay an additional $400,000 or more in total costs. That's the hidden price of stretching payments so far. It looks cheaper now, but becomes dramatically more expensive in the long run. Lenders determine rates based on time and risk. The longer they have to wait for repayment, the greater the risk that inflation, economic downturns, or life events will affect those payments. That's why 15-year loans are cheaper than 30-year loans. The lender gets their money back faster and with less uncertainty. Extending to 50 years adds risk, so interest rates will almost certainly rise. Think of it like this. If you loaned a friend $1,000, would you charge the same interest to get paid back in 1 year versus 50 years? Of course not. The longer you wait, the less valuable that money becomes due to inflation and lost opportunity. The same logic applies to mortgage lenders and investors. They'll demand a higher return to make it worthwhile. This is why the idea of a 50-year mortgage doesn't align with basic lending principles. If rates climb even 0.5% higher than a standard 30-year loan, any supposed monthly savings vanish instantly. Borrowers end up paying more overall, while banks and investors take on greater uncertainty. Behind every mortgage is a chain of investors, banks, and financial institutions that buy and sell these loans. Most 30-year mortgages are bundled into mortgage-backed securities that align with the 10-year Treasury bond because most homeowners sell or refinance after about a decade. This system depends on liquidity, money moving efficiently through the financial market. A 50-year mortgage disrupts that entire balance. Investors don't want to wait half a century to get their principal back. If interest rates fall, borrowers refinance and pay off early, cutting into profits. If rates rise, investors are stuck holding low-yield loans for decades. Either way, the risk is higher, and they'll demand higher rates or avoid those loans entirely. This is why banks may hesitate to offer 50-year mortgages broadly. They would have to tie up massive amounts of capital for extremely long periods. For example, if a bank issues 1,000 such loans in 2025, those assets remain on the books until 2075 unless refinanced. That's a risky, slow-moving investment in a world where financial markets thrive on liquidity and turnover. Now let's talk about the hidden danger for everyday homeowners. A 50-year loan builds equity so slowly that if home prices fall, Owners can find themselves owing more than the property is worth, a situation known as being underwater. For example, someone who buys a $550,000 home with 10% down might still owe nearly the same amount after 12 years. If the housing market dips even slightly, they could lose their entire down payment. We've seen this before. During the 2008 housing crisis, homeowners with interest-only or ultra-long-term loans faced massive foreclosures when home values dropped. Many discovered they had built little to no equity despite years of payments. The same risk would exist, if not magnified, with a 50-year loan. Imagine a homeowner in Las Vegas who needs to relocate after 10 years. They discover they've paid down only a small fraction of their mortgage and now must sell in a cooling market. After realtor fees and closing costs, they walk away with almost nothing. This isn't an investment. It's renting from the bank for decades while carrying all the risk of ownership. Under current federal law, the most affordable and safest loans, called qualified mortgages, cannot exceed a 30-year term. These loans come with consumer protections and better pricing because they're backed by Fannie Mae, Freddie Mac, or FHA. A 50-year loan would fall outside that framework and be considered a non-qualified mortgage, meaning fewer protections and higher interest rates. Changing that rule would require significant policy shifts from the Consumer Financial Protection Bureau and Congress. It's not as simple as flipping a switch. Regulators would need to rewrite lending standards, adjust capital requirements, and convince investors to accept much longer repayment timelines. That's a process that could take years and invite enormous political debate. So even if developers or lenders wanted to offer 50-year mortgages tomorrow, they couldn't do so on a large scale under existing federal lending rules. The legal framework simply doesn't support it. Without these protections, most borrowers would face higher costs and greater risks, precisely the opposite of what this idea promises. If the goal is to make homes more affordable, extending debt for half a century isn't the solution. The real problem lies in the lack of supply and the rising cost of land and construction. Building more homes, especially starter homes and affordable housing, is the most effective way to bring prices down. Policies that encourage development and modernize zoning laws can make a far bigger impact than longer mortgages ever could. Another idea is to reform capital gains rules. Right now, many homeowners hesitate to sell because they'd lose large portions of profit to taxes. Increasing the exemption limit would encourage more people to list their homes, boosting supply and reducing price pressure. Likewise, allowing people to transfer their low-interest mortgages when they move could unlock inventory that's currently frozen by high rates. Real solutions should focus on ownership, not endless debt. First-time buyer programs, down payment assistance, and temporary interest rate buydowns can help families achieve stability without extending payments into the next century. Affordability isn't about how long you borrow, it's about how smartly the system helps you buy. At first glance, the idea of a 50-year mortgage sounds like innovation. Lower monthly payments, easier qualification, more options for buyers, it checks all the marketing boxes. But when you dig deeper, the math doesn't hold up. Payments barely drop, total costs skyrocket, and equity growth slows to a crawl. It's not a path to affordable ownership, it's a recipe for generational debt. Most Americans move or refinance within 10 to 12 years. That means very few people would ever see the theoretical benefits of a 50-year mortgage. Instead, they'd spend decades paying mostly interest while the bank profits from their long-term obligation. The system works best when buyers build equity, not when they stay indebted for life. So before celebrating a 50-year mortgage as a game changer, let's focus on the real solution: building more homes, updating lending policies, and supporting programs that help people buy smarter. That's the difference between owning a home and owning one forever. If you found this breakdown helpful, make sure to hit the like button and subscribe to stay updated on everything shaping America's housing market. We'll keep tracking whether this 50-year mortgage idea actually moves forward or fades away like many past proposals. Let us know in the comments. Would you ever take a 50-year mortgage, or do you think it's just another financial trap? Thanks for watching, and remember, real financial freedom isn't about how long you can borrow, it's about how quickly you can own. Stay smart, stay informed, and I'll see you in the next video.